The AI gold rush has reached a point of exhaustion for the average investor. While mainstream media celebrates tech giants, a massive macro shift is happening in the small cap market. There's a profound disconnect between where big money flows and where the retail crowd looks. Today, we move past the hype to look at the invisible AI backbone. We've identified two specific plays institutions are circling, one at $0.85 and the other at $1.23. Most think these are penny stocks, but they are specialized gears allowing the AI engine to turn. One controls a massive data flow ecosystem in the world's largest market. The other is a specialized shield protecting infrastructure from total collapse. Which layer of the AI stack holds the most asymmetric potential? AI infrastructure expansion is no longer just about faster chips or bigger data centers. It's moving into implementation, defense, automation, and telecommunications. This is where real market inefficiency lies. Everyone stares at AI's face, chatbots, and image generators. But attention completely misses the nervous system. This is where pricing inefficiencies usually exist. Institutions don't chase hype. They quietly watch essential, overlooked layers. They know massive players rely on smaller, specialized providers. This doesn't guarantee anything. Investing at this level involves high volatility and unique risks. But it explains why this area matters now. As megacaps overextend, smaller cap opportunities form. They wait for the market to catch up to their utility. Our first stock is the data fuel engine. It operates in a niche most AI investors don't know exists. It doesn't build AI. It provides high-velocity consumer data and telecom insights. This allows AI algorithms to understand human behavior in real time. Imagine an AI predicting consumer trends before they happen. This company provides that infrastructure in a market of over 1 billion people. But here's the catch. Its critical role is disconnected from its stock price. While this stock focuses on fuel, AI is only as good as the data it's fed. We're seeing a massive shift. Big data is being recategorized as AI fuel. This company fits perfectly into that transition. They've built a mobile payment and data ecosystem for years. As AI integrates into smartphones and shopping, companies like this become critical infrastructure. You can't have a localized AI economy without their specialized data pipes. This is what most people miss when they look at the chart. This stock has a history of massive explosive moves. It moved from $1.50 down to its current base at $0.85. It spent months pulling back and stabilizing, shedding weak hands and forming what looks like a long-term accumulation zone. Now, with the AI narrative heating up, is the market ready to retest those previous highs? Their business model isn't just a paper promise. They have active partnerships with massive telecom providers. They are already processing millions of data points. They're a big data firm, pivoted to the AI revolution. This is where things shift. When you look at the company, you see a firm positioned at the heart of the world's fastest-growing digital economy. The company is Finger Motion Inc., ticker FNGR, currently trading at just $0.85. Why is it still under $1? The market labels it telecommunications rather than AI infrastructure. This doesn't mean it moves tomorrow. Real risks exist: regulatory shifts and small cap volatility. Timing is key, but the disconnect between data assets and market cap is why we're watching it. Before our second stock, here's what most people overlook. AI demand is exploding. Yet, vital infrastructure players see delayed price reactions. Why? The market is stuck in first phase AI investing. We're moving into the second phase, where backbone stocks finally catch the bid. Unlike the first company, which feeds AI with data, our second stock is the Defender. In AI, speed is everything, but security is the ultimate priority. Where the first operates in data flow, this one operates in mission-critical cybersecurity. It challenges old, slow network protection. It uses AI to fight AI. This company specializes in AI-driven continuous compliance and cybersecurity. Most companies check security once a year. This company's AI checks it every single second. It's a real-world application every government agency and major corporation desperately needs. The cybersecurity industry is undergoing a forced evolution. Hackers use AI to launch attacks. Human defenders are no longer fast enough. If AI adoption continues by bad actors, this defense becomes more relevant. It's not just a nice to have, it's a requirement for survival. Looking at price history, this stock saw significant price discovery, followed by consolidation. It's now sitting in a very tight range, waiting for the next major contract or industry catalyst. This is the setup high AVD investors look for, the quiet before the volume returns. When you look at the leadership team, former heads of major security agencies, the credibility gap closes. The company is CyberCatch Holdings Inc., ticker CYB, trading at approximately $1.23. It's still cheap because cybersecurity is a crowded market. The market hasn't distinguished legacy from AI-first challengers. This doesn't guarantee anything. Risks exist, fierce competition, and being a smaller player. Now, we have a mental battle. On one side, finger motion, FNGR, the 085 data engine. On the other, CyberCatch, CyB, the 1.23D defender ensuring the AI revolution isn't a security nightmare. Which one benefits faster if X happens? If the market focuses on consumer AI growth, finger motion has the edge. But if we see a wave of high-profile AI hacks, the spotlight shifts instantly to CyberCatch. One represents growth infrastructure, the other, safety infrastructure. This isn't just a choice of stocks. It's a choice of which part of the invisible backbone the market realizes is essential first. The price difference is negligible, but the narrative contrast is massive. At the end of the day, both are part of the invisible layer of the AI revolution. The market often ignores this layer until the very last moment. This layer tends to move later, but often more aggressively, because big money moves fast. We are tracking the backbone, not the hype. Hype stocks get headlines. Backbone stocks get institutional utility. If you want to follow the smart money into these infrastructure layers, subscribe to Stock Signals Hub. Let us know in the comments. Are you betting on the data fuel or the AI defense? We'll see you in the next analysis.